Gary has no mortgage. He paid it off 4 years ago, 3 years ahead of schedule. He made extra principal payments every month from the time he was 45 until the bank sent him the satisfaction of mortgage letter. He framed it. It hangs in his home office next to the photograph from his first day at the company where he spent 31 years. His son watches him do things with money that do not make sense on paper. Gary keeps $40,000 in a savings account, earning less than 1%. He will not put it in an index fund. He kept a CD ladder for years when the yields were laughable. He paid cash for his last car. He has never carried a credit card balance in his life. He describes debt, any debt, as a form of personal failure. His son has read enough to know that paying off a 3% mortgage before maxing a retirement account, returning 7%, is not the optimal financial move. That the $40,000 in savings is losing purchasing power every month to inflation. That Gary's risk tolerance is calibrated to a world that no longer exists in the same form. His son is not wrong, neither is Gary. That is the part of boomer money psychology that almost nobody explains correctly. Here's the thing. Gary is not financially illiterate. He is financially fluent in a language that was correct for the economy he formed in, and partially misapplied to the one he retired into. The gap between those two economies explains almost every boomer money habit that confuses younger generations. Understanding it does not require agreeing with it. It requires knowing what Gary lived through before his opinions about money were fully formed. Gary was born in 1962. He graduated and entered the workforce in 1984 at 22 years old. The economy he stepped into had just survived one of the most financially disorienting decades in American history, and the generation that raised him had survived the one before it. The 1970s were defined by inflation in a way that no decade since has replicated. Consumer inflation peaked at 13% in 1979. Not 2%, not 4%, 13%, meaning prices doubled roughly every 5.5 years. A dollar in 1970 was worth approximately 47 cents by 1983. Savings accounts at federally insured banks were paying 5, 6, 7, 8% interest during this period. CDs were paying more. Holding cash in a high-yield savings account was not irresponsible in that environment. It was mathematically rational. The real return on a federally insured savings account was positive. Gary's parents bought a home in 1964 for $22,000. By 1984, that home was worth $110,000. They had not been financially sophisticated. They had bought a physical asset, paid it down, and watched it appreciate through 2 inflationary decades. The lesson the family drew from that experience was direct. Real property is real wealth. Paper assets are promises. The Depression had wiped out promises. Real estate had survived. Gary inherited that framework at 22 and entered a job market that was actively confirming it. Mortgage rates in 1984 were still above 12%. His employer offered a defined benefit pension. The stock market, from Gary's perspective, was a place where other people sometimes made and sometimes lost large amounts of money in ways he could not control or predict. He built his financial habits in that environment over the following decade, and then the environment changed, slowly enough that the habits did not change with it. The habits and where they came from. Boomers who managed money well in their prime years typically share a cluster of behaviors that look irrational to a younger observer. Each behavior has a direct origin in the economic conditions of the 1970s and 1980s. Pay off debt aggressively before investing. In 1985, a 30-year fixed mortgage rate was approximately 13%. A savings account was paying 6 to 8%. A money market fund was paying 10%. Paying off a 13% debt obligation before parking money in a 6% account was mathematically correct. The spread made debt elimination the highest guaranteed return available in the market. Gary learned this principle in his early 30s and never had a reason to revise it, because every time he applied it, it worked. He did not update it when rates compressed because the rule had never produced a wrong answer in his personal financial history. Keep significant cash reserves. In a high-inflation, high-yield environment, cash-equivalent instruments with competitive yields served simultaneously as liquidity reserves and inflation hedges. Money market funds in the early 1980s were yielding 10 to 12%. The habit of maintaining large cash positions was not yield chasing. It was basic risk management in an era when short-term rates were genuinely competitive with equities. When yields compressed across 2 decades, the cash habit remained. The psychology survived the economics. Own the home outright and treat it as primary wealth. Home equity was the central retirement savings vehicle for the generation before Gary's and for a large portion of Gary's own generation. The combination of a defined benefit pension covering income replacement and a paid-off home, covering housing cost elimination, in retirement produced genuine financial security without requiring a sophisticated investment portfolio. Gary built his entire retirement plan around these two pillars, which is why the mortgage payoff letter meant more to him than the investment calculations his son ran on it. Here's the thing. These habits were not born from ignorance or stubbornness. They were born from an economic environment that made them correct. They calcified as identity before the environment changed enough to require revision. And identity is far more resistant to updating than investment strategy. The market psychology. Gary does not trust the stock market. He will say this without hesitation or embarrassment if the subject comes up. He has watched it collapse 3 times in ways that felt permanent while they were happening, and the timing of each collapse mattered enormously to the shape of his distrust. In October 1987, the Dow Jones Industrial Average fell 22% in a single day. Gary was 25. He had just started contributing to his company's profit-sharing plan, the beginning of what would eventually include a 401k option. He watched the account statement arrive in January showing a value below what he had contributed. He increased his cash savings the following month and maintained higher reserves from that point forward. In 2000 and 2001, the dot-com collapse wiped out the paper retirement wealth of millions of Americans. Gary watched colleagues who had concentrated their retirement savings in technology stocks lose 60, 70, 80% of their account values. He watched men his age who had planned to retire at 55 extend their working years by a decade to rebuild accounts they had spent 20 years filling. His conservative, bond-heavy allocation looked correct by comparison. But here's what. In 2008, Gary was 66, entering the 2 years before his planned retirement date. His portfolio dropped 31% in the 12 months following the Lehman collapse. He restructured into bonds and cash at the bottom of the market. He missed the recovery from 2009 through 2012. He knows this. He has run the numbers. He does not regret the restructuring. The psychological cost of watching the account fall while retirement approached was, to Gary, more significant than the financial cost of missing the subsequent recovery. This is not an irrational position. It is a risk tolerance shaped by the sequence in which the crashes occurred relative to his age, his accumulation phase, and his proximity to the point at which the account needed to be accessed rather than recovered. The problem is not that Gary is afraid of the market. The problem is that his fear was formed in a specific sequence of events that he experienced as confirmation rather than as anomaly. The pension mentality. Gary worked for the same company for 31 years. He received a defined benefit pension at retirement, a monthly payment that continues for the rest of his life, regardless of market performance at a rate calculated from his final salary and years of service. He did not have to manage it. He did not have to make asset allocation decisions. He did not have to understand sequence of returns risk, withdrawal rate math, or inflation-adjusted spending projections. He showed up. He performed. He waited. That structure shaped his relationship to financial planning in a way that is essentially invisible to anyone who graduated into a 401k-only world. Gary's retirement security was guaranteed by an institution. The financial decisions, asset allocation, risk management, income distribution were made by actuaries and fund managers, not by Gary. His role was compliance with the employment agreement, not mastery of investment strategy. And here's the part. The shift from defined benefit pensions to defined contribution, 401k plans, happened gradually through the 1980s and 1990s. Many boomers experienced both systems. Gary contributed to a 401k in addition to earning his pension, but his mental architecture of retirement remained pension-based. The 401k was supplemental savings in his framework. In his son's framework, the 401k is the entire plan. The result is a generation that, on average, undersaved in retirement accounts relative to what was required, once pensions became the exception rather than the rule. Because the savings behavior was calibrated to supplement a guaranteed income base that many of their children would never receive. The supplemental mindset produced supplemental balances in a world that required total self-funding. What they got right. The boomer money psychology is not uniformly wrong. It is contextually wrong in some applications and permanently correct in others. And the correct parts deserve direct acknowledgement rather than being dismissed along with the savings account yield. No consumer debt. Gary has never paid $1 of credit card interest. He does not lease vehicles. He does not finance furniture or appliances. He does not borrow to fund discretionary spending. This is not a dated habit. It is a permanent financial principle. Consumer debt is among the most reliable mechanisms for transferring wealth from people who need it to institutions that profit from lending it. The specific instruments change across decades. The principle does not. Spending below income consistently without exception. Gary has always lived on less than he earned, not dramatically less, but the gap between his income and his spending was a gap he maintained through promotions, raises, and the full arc of middle-class lifestyle inflation. He did not treat salary increases as spending capacity increases. He treated them as savings capacity increases. This discipline, compounded over 40 years, produced the financial security that his investment suboptimality could not fully undermine. Here's the thing. The critique of boomer money habits focuses almost entirely on what they did wrong: the conservative bond allocation, the cash hoarding at low yields, the early mortgage payoff at a low spread. The harder acknowledgement is what they built despite those errors: paid off homes, stable retirements, no consumer debt loads, and a lifetime of directing a surplus towards something purposeful. The habits were imperfect instruments applied with genuine discipline. The combination worked, not optimally, but well enough to produce generational wealth for millions of people who received no formal financial education. Where the psychology fails now. The boomer financial framework fails specifically when its era-dependent applications are treated as permanent principles and carried unchanged into a different economic environment. A 30-year mortgage at 3% should not be paid off aggressively before maxing a retirement account compounding at 7%. The arithmetic that justified early mortgage payoff in 1988, when mortgage rates were 12% and safe money yields were 8%, produces the wrong answer in 2018, when the spread is reversed. The rule did not change, the numbers did. Gary's son, who received the rule without receiving the historical rate context that generated it, applied it in an environment where it cost him compounding years he cannot recover. Keeping $40,000 in a savings account, earning 0.5% while consumer inflation runs at 4%, is a guaranteed annual loss of purchasing power. The habit of maintaining large cash reserves was financially correct in an era when those reserves generated real returns. It is not correct when the reserves generate negative real returns every month. The psychological attachment to cash as safety has outlasted the economic conditions that made cash safe. But here's what. The largest failure of boomer money psychology is not in the habits themselves. It is in the transmission. The habits were passed down to children without the context that made them correct. No debt, cash reserves, own your home, avoid the market. These arrived in a 3% mortgage, zero yield savings, no pension world, as handed-down wisdom without the rate environment, inflation history, and institutional context that originally justified them. The advice was transmitted. The economics were not. 3 things. Understanding boomer money psychology produces 3 practical extractions, regardless of what generation is doing the reading. First, separate the principle from the era-specific application. Pay off high-interest debt before investing is a permanent principle. The math will always support it. Pay off 3% debt before capturing a 7% return is an era-specific misapplication of that principle. Maintain cash reserves is a permanent principle. Keep cash in a zero-yield account during inflationary periods is an era-specific misapplication. The principle is portable. The specific application depends on the current numbers, not the numbers from the decade in which the principle was learned. Inheriting the application without the underlying principle produces the worst outcome. Second, audit what boomer discipline actually built. The boomer generation accumulated more household net worth than any prior American generation, using instruments that were frequently suboptimal by current analysis. Paid-off homes, moderate retirement savings, zero consumer debt, and a consistent savings surplus compounded over 40 working years produced genuine financial security for millions of people who were never taught to invest. The discipline was the engine. The instruments were imperfect fuel. Dismissing the discipline because the fuel was wrong misreads the outcome. Third, translate, do not discard. The practical move for anyone who grew up in a boomer financial household is to identify which habits are era-specific applications and which are permanent principles. Then, update the applications while preserving the principles. Keep the no consumer debt rule. Update the savings account to a high-yield instrument. Keep the surplus discipline. Update the mortgage payoff math to account for current rates. Keep the distrust of speculative risk. Update the definition of speculative risk to exclude broad index funds. The psychology is worth keeping. The specific instruments it produced are negotiable. Here's the thing. Gary built what he built with tools that were correct for his era and a discipline that is correct for any era. The generation that dismisses him because his savings account earns nothing and his 3% mortgage is paid off has misread what to learn from him. The lesson is not the savings account. It is the 40 years of directing a surplus towards something every month without exception, regardless of what the market was doing. The close, Nari. Gary does not understand why his son carries a 3% mortgage instead of paying it off. His son does not understand why Gary keeps $40,000 earning nothing. They are both applying correct principles to different economic contexts and arriving at conclusions that look irrational to the other person. The conversation they are not having, because neither has framed it this way, is the one about what the principles actually are underneath the habits. No consumer debt. Spend below income. Direct the surplus purposefully. Maintain reserves. These are the principles. The savings account, the CD, the early mortgage payoff. Those are the era-specific applications. The applications are negotiable. The principles are not. Gary's generation built something with those principles, imperfect instruments and all. The generations that followed inherited the critique of the instruments without always inheriting the discipline that drove them, and found themselves with updated financial tools and no particular habit of pointing them at anything. You may not agree with how Gary handled his money. The question is whether you understand why he handled it that way, and whether the discipline underneath the specific decisions is something you have found a modern equivalent for, or just something you have decided you do not need. This is what we do at Vaulted Finance, the kind of money math that doesn't make the headlines but quietly decides how the next 30 years of your life actually play out. New breakdowns drop here regularly, so subscribe if you don't want to miss the next one. And drop the topic you want us to break down next in the comments. We're reading, and the most requested ones are the ones we cover first.